Good morning everyone, welcome to the Eurostream. I'm your host Market Stoker D. If we're meeting for the first time, I've been trading for 19 years at this point. I am a commodities focused trader, so we'll be looking at precious metals, base metals such as copper, and some energy markets as well, because natural gas has been moving recently and it is in the list of my tradable products. So with that out of the way, let's overview copper first. I have been trading copper nearly every day in the last couple of months. It has plenty of volatility, but at the same time it's not as insane as as some of the other metals like silver and gold. You have seen that Topstep has placed some restrictions on the live and XFA accounts because of this volatility. Some people don't agree with that, but I fully support that. I've seen a lot of stick for Topstep for doing that, but I think that they are actually working to protect the traders, because they've seen a lot of people blowing out since they tried trading minis on gold, copper and silver, and promptly blowing out in seconds, not even minutes. Why? Because the drawdowns that are offered initially on those accounts, they're pretty low. You would need a much bigger balance to be able to absorb whatever the metals are doing, and similar with natural gas as well. Right, so we're going to start with the statistical extremes. So we're working with the ADR low at 67.40, so 567.45, let's say, on copper is what statistically you can expect to the downside if it starts moving down. And to the upside, we have 604.15, let's say, to the upside. The next point that I like to look at is what the Asia did. So right now, Asia range is sitting between 595.95, and to the downside, Asia low is sitting at 577.25. Why do we look at Asia range? Well, because Asia in the Shanghai exchange is a pretty important session for metals, since they are traded very widely, and some of those contracts are used for benchmarks around the world. So the price discovery first happens during Asia, and if you are trading a product that is active during Asia, you really need to pay attention to what the overnight did. So this is why I always use it for orientation. Following that, I have some gamma levels. So gamma levels, I look at the bigger ones, not any and every one, but I literally take them only if they have some open interest and implied volatility attached to them. So we have the bigger call wall today at 590. But it's not as big as the one at 6 evens. That number, the 6 even number, has been an orientation point and or dealer hedging point for quite a while now, going on about a month. To the downside, we have a bigger call wall sitting around 570, very close to that ADR low. So that would be an area where maybe I would become a buyer, unless we end up with some sort of a mad single print date to the downside, meaning the auction is very strong. This is pretty early in the day, so I do like to chill before I see some more volumes coming in. And typically this part of the day tends to be the quieter part for the metals, but at the same time there are some clues that we can derive. Looking at the value area from COMEX from yesterday, because COMEX carries the highest amount of volume on those products, we're sitting just under the value area. So this whole purple distribution curve, that represents the value area. Why is this important? Well, if we open up inside value, That could mean a slightly quieter day, more range bound, and it's not impossible to have a breakaway from that area where everything just goes crazy to one side, but it's tricky, right? So if we open inside range, there is a very good chance that we just stay like sort of Asia range bound and not do anything else. Having said that, these ranges are so massive. We are still working with 365 tick range for Asia, so nearly 400 ticks, and that is plenty to find any opportunities, even if we do end up in a range day. One thing to watch out for is that if you get a lot of inside bars when COMEX starts, so everything's kind of overlapping, lots of wicks either side of the candles, that means that you need to wait until that is resolved, or maybe take smaller scalps as well within the extremes of that range. So there's always a way to position yourself, but we do need a little bit of a span between any ranges that get established throughout the day. So for now, we're sitting just under VWAP as well. This is a Globex anchored VWAP. One other thing that I like to do once the London Metal Exchange starts trading, I actually anchor an additional VWAP to the start of that. The LME Open happens at 11:40 a.m. GMT, and let me just convert that to the central time, so that would be 5:40 a.m. So if you're looking at anchoring the VWAP there, that would be the time to go down to a 5-minute chart, anchor it there, and then see where the price is floating and whether it's reclaiming it or whether it's maybe breaking down through it. I'm just gonna mute myself on the YouTube side of things. Okay, I'm still practicing my new way of entering and executions. So I first, whenever I'm changing something, I never do that in the accounts that matter. So I am looking for proof of concept that the adding on to the trade when it's in profit works. That was always a pain point of mine. The way I used to scale into accounts, it would be one scale in. Like, let's say I'm starting with the assumption that my maximum default position size is going to be 15 lots. I would be entering 5 lots at the first sort of trigger point of my my zone that I'm looking at, because I never look at singular price points. I look at all of this as a zone. So for example, if I want to be a buyer, I'll be looking at this whole area as my area of interest, and then I watch the lower time frames. And I do watch tape as well for things like cumulative delta and a lot of other things. And just looking for that reversal and momentum. One thing that I would do is maybe front run the first trigger point. And then if it dips a little bit into the drawdown, I will be adding another 5. And only when the trade would move in my favor, I would add the next one. Now that's great if you have a lot of size, right? If you have a big account and if you're working with a core position of many multiples. And it worked for me for many years, but we're talking prop accounts here. And you know, I've been trading for such a long time that this whole micros thing is a fairly new development in the whole of the career that I've had. And I never fully gave it attention. I was like, yeah, whatever, micros, right? But I kind of failed to realize that if you have a smaller account, that can actually be incredibly powerful. So I'm looking to switch around some of my executions, all the while keeping the risk of ruin in the smaller beginning accounts to between about 6 to maximum 10% when we look at an entire year. But I'm also looking to maximize the upside, because what's the point of trading prop if you can't scale up, right? So that's all the stuff that's been keeping me up at night. So I've been doing a lot of data crunching in probably the last month, just seeing how I can make everything more stable. and whether I am comfortable with the new way of executions. Now the add-on points are not going to be random for me. They are very much dependent on something called the MFE. Now MFE is just a fancy way of saying, well, how much swing does this product have before it goes into the next drawdown? You know, how much run up does it do before it dips down and then carries on? That's called maximum favorable excursion if you look at just price action. And I said it before that I'm not really big on equations, so I do use AI to help me do that. And I'm working with sample sizes of about 6 months on copper, so I didn't use like 2 days or just the last week or so. I'm using a bigger sample size to figure out where the scaling points should be. And you know, so far I'm really happy with the stability of it. I'm trying to reduce the variance between, you know, the losses and the wins. And what this does is to minimize the drawdown if you are completely wrong. So you will only be in, or I will only be in with 4 micros. And if I'm just outright wrong, it never actually moves in my favor. It just kind of dips down for whatever reason and whips me out. It could be a tape bomb. It could be just being outright wrong on the trade idea and then just carries on. Then you only lose 4 micros, right? You don't lose 10, 15, 20, right? Or 1, 2, 3 minis, which is even worse. But once I see the momentum, once delta starts moving in my favor, that's when the add-ons are happening. So the first add-on that I have is fairly aggressive. It's already 10 ticks in profit. And again, you will be in with 5 micros at that point. Even if you get smacked in the face and you're still wrong, you're only losing 5. So in the events where the price action just doesn't move in your favor, it's very unlikely that it's gonna pick up all of the add-ons that I have. And right now I have the add-ons for copper at 10 ticks, 18 ticks, 26 and 34. That's what these markers are here for. I also have them in this little sticky note just to kind of remind me of the scaling point. So that's what I'm practicing, and it requires a little bit more management on my part, because when you scale in, the way this platform works is it doesn't add onto the resting order, so I have to add one, and then I also have to add the limit order for the profit, and they're just going to track how it's going. Now once it's in profit and once it's fully scaled in, I will then look for a full 50 ticks profit of the scale in before I move the stop anywhere. And copper is a pretty smooth product, so it is safe to move the stop loss to break even once the trade goes 50 ticks in profit and over. It's not safe to do so before then. Why? Because there's still a lot of range here that we're working with, and I generally dislike trailing stops, and I think this is because I traded crude oil for such a long time. And if you try and trail on crude oil, it's so whippy intraday that you will never be in long enough in order for the bigger targets to come into consideration. And I'm still working with RBOB and natural gas, so gasoline futures and natural gas. You still shouldn't really mess with the stops. I look for, so on RBOB I'm using 85 ticks for a stop, and I am using 2R multiples as my target. And now something that I've noticed in RBOB is that yes, you can move it to break even, but only when it's already like 100 ticks in profit, but you're already nearly at target then, so it's like, what is the point? And therefore on RBOB and natural gas I still don't trail stops, because I want to give it the full chance to work. And with the way I look at my trade locations, because I'm getting involved at important pain points, you know, I'm getting involved at the swing extremes, I'm getting involved at like value areas and stuff, so they are all areas that generally make the price move away from it pretty heavily and confidently. So if you're not working with those levels, you might find that you will be wrong quite a bit, or that your trades have to be much shorter than mine, and that you will have to take quicker profits. I don't like doing that. I like to trade with smaller size comparative to the account balance or the maximum drawdown that I have, and then look for those slightly bigger positive R multiples, not to like a crazy degree. So I don't sit here and go, right, today, every single day we're going to get, you know, a 10R movement. I don't do that. If I can get 2R, I'm happy. If it's a range day, if I can get 1R, I'm happy. So context will matter. My risk reward is not static. If we're coming away from a bigger swing and I see that the implied volatility on the day is sufficient to push us in the direction that I want to see the swing happen from, then I will increase the target to whatever the market gives me. And on those days, I will work on time-based targets over price-based. So I will literally try to stay in for as long as possible, until the next problematic time of day comes in. So what is the problematic time of day? Well, it's the points where statistically you see reversals happening a lot. So for example, that will be the post and white cut. So that's around 9 a.m. Central, that's 3 p.m. my time. And it will also be half an hour before COMEX close, because whatever move you had in those last half an hour before COMEX settles, you typically see a pretty heavy reversal. So, you know, you don't want to lose out on profits at that point. And that is the time when I will be like, okay, time to close. And I'm very systematic with that. I do not think it over. I don't wait for things to happen. I will just take whatever is there at that time. And that also goes for any smaller targets that are maybe 2R, but we get to COMEX close and I've been holding the trade for 3 hours. And it's just not getting there, I will still close it for whatever money it's given me. So that's what I'm working on. That's the reason for Combine, just looking for proof of concept before I move it back to the XFAs. But yeah, some practicing has to come into consideration because it's a lot more than I usually used to do. And I do like the stability of it for now. Alright, let's see some chat and who's in. So, good morning everybody. AG Trader is there. Yeah, fully supportive of restriction. One does not need any more than 3 micros in this market. You know what, on gold, I don't think you need more than 1. Not that it gives you much flexibility to scale in or out, but, you know, one micro, you can easily make, like, over $1,000, $2,000, $3,000. You know, we're talking about gold that currently moves 3,000 ticks a day. That's a big range, right? And if you manage to find a trade on 1 micro on $1 per tick, even if you grab like half of that range, that's a lot of cash, right? And remember that we are risk managers first. So you're supposed to, we're risk takers, of course, but we're also risk managers. And that means that if you're not mindful of the downside and the danger, market risk that these products currently provide or are threatening us with, then you're not a true trader. There you go. I said it. When funded, the scaling plan applies. Yeah, so scaling plan applies before you have 1,500 in profit. And I think then they open up the purse strings, from what I remember, unless they change the scaling plan. I've been with Topstep for like 10 years, and I feel that sorry, one of my dogs is again sick. I think they feed him. The bird is allergic to chicken and beef, and every time he comes back from doggy school, the next day he's usually not doing that great. So just wonder whether they're feeding him some biscuits that are chicken related. Not realizing the extent of his food intolerance. I'm gonna have to jump on that. Yeah, so the scaling plan, you know, I've been with Topstep for 10 years and they've always had the scaling plan in place. What's changed is the sim funded part. You know, before you used to pass the 2 phases, and then they would put 5 grand into a live account immediately, and then that was it. And you would have the scaling plan in all 3 phases. So phase 1, phase 2. Phase 2 was horrible. Phase 2 was like your daily loss limit becomes your weekly loss limit. And it used to take like such a long time. It used to take like 2 months before you would even get funded. Obviously, the industry has changed throughout the years, especially in COVID. Suddenly we got micros, suddenly we got sim funded accounts, and you know, all of that. And I've watched it develop. It is a good thing, but it's also a bad thing for people who still don't have proof of concept, and yet they have this ability to either buy accounts immediately or to pass them in like 1 or 2 days. And I think this is the reason for lots and lots of blowouts in the first day. You never get that proof of concept because a lot of people refuse to stay in the combine environment. Oh, I want to get those payouts. That's great, but you're never going to get payouts unless you get proof of concept first. And, you know, trading in a safer environment where you've paid a little bit of money for, skin in the game and all that, to get those emotions. And then you have other people who constantly try to pass it in 2 days and they never even get to the funded level. So, yeah. But yeah, so, yeah, and they also aren't forever restrictions. Yeah, his Quay says that's true. Who is able to trade with 150 silver right now? Well, the institutions, you know, they don't trade. They even trade like 150 big silvers, you know, and that's really what we look for as order flow traders. I'm not looking for, you know, what the dude down the road who's in a Topstep Live account trading with 1 micro on gold is doing. You know, I'm looking at what the JP Morgans, Merrill Lynch's of the world are doing. And even though we don't know exactly which institution the large size is coming from, you know how we say on TopstepTV, seeing like 200 contracts on the dome. Well, if you see somebody trading 150 full silvers, that's not going to be, you know, a retail trader. That's going to be an institution because that's a lot of size. And we don't know the intention of the institution. Are they getting out? Are they getting in? You know, we don't know what those orders on the dome truly are, but we do know that they're trading with size. So we look for those big orders as the indicator of where the market might move. Same thing with large sweeps that you might see on Bookmap. Large sweeps are never really caused by tiny traders blowing out. They're always either institutions closing out positions or initiating new ones. So, you know, that causes a jolt in the market. And as order flow traders, that is what we look for. We want to see what the big boys are doing and then trade with them, not against them. AG Trader has a point. They should have restricted to no more than 2 on micro silver. 5 micros on silver is still too much. Yeah, they're still being super generous, right? They're still like, hey, if you want to trade 5 micros, yeah, just trade 5 micros. So I don't really understand the backlash that Topstep has gotten from people. I've seen a lot of Instagram posts that are like, Topstep, can't believe Topstep did this. It's like, dude, they're letting you trade 5 micro silvers. You really shouldn't be in with more than 1, in my opinion. But what do I know, right? How many trades do you guys do each day? So this will really vary. If I am looking for a bigger swing potential, that would be just 1 or 2. Like, I wouldn't be looking to outperform the market when I have a directional day. I want to grab as much as possible in a single trade. So less work, more money, more ticks, lower size, and still killing it. And in fact, some of my bigger days recently, like in January, in January, I did have quite a few days where I made like between 4 and 6 grand. And that was all done on 1 trade. Like I held a silver trade from Shanghai Open all the way through to nearly COMEX close on the days when it was just shooting up and up, because there was no reason to get out of it. And it was only, I think it was like 2 microsilvers. It's crazy, like crazy amount of movement. Just gonna keep going and going. And you know, I left it in. I was like, let's see what the silver fix does. Nothing. It was just a little tiny squiggle, and then they shot it up again. So same thing for initial balance COMEX. They had a bit of a pullback and then immediately into a higher high. It was one of those days. So on those days, you know, one trade is more than enough. But if I'm having a day where, you know, the everything's a bit slower, I will jump from different product from let's say copper to silver to nat gas to RBOB. And on those days, I will do, like, as a core setup without scaling in and out, like, you know, not counting those, even though the platform counts those. That would be like between 6 to 10 trades a day. You know, I might grab a couple during London. If I'm trading Asia, I will also do like 1 or 2. So that's already, what, 4 trades. Then you get to the post-NY cut when it's like my prime time of like probabilities of what I do. I will probably run 2 concurrent trades on 2 products. If one of them is kind of not really gaining momentum, I will kill that, maybe for scratch or a few ticks, or maybe you know, a little bit of a drawdown. Again, a few ticks, not letting the trade completely get smashed into a stop loss, if I can help it. And after 90 minutes, you should really know the way I trade. You know, after 90 minutes, if I've not gotten what I want, any kind of movement in my favor, I do just close it out. And I'm like, well, it should have done it already, right? And then towards the end of the day, I will usually do another couple, maybe 2 or 3. So yeah, about 10 trades per day is what is on the more, like on the bigger side. Now with this scaling in, because this account and the way they've made the platform, it counts every scale in and out as in a separate trade. You will start seeing more trades because of that, but it still doesn't mean that I'm trading like 30 trades a day. It still means that I've traded 1, scaled in to, you know, additional 4 or 5 trades, so immediately that would count as 6 or 7 trades. So if you then apply the calculation of 6 or 7 trades with 4 or 5 scale-ins, you do get to like a lot of trades on the day, but it's not, you know, it's not the core, it's not different separate playbooks, it's just scaling in and out. So hopefully that's a little clearer. But yeah, for me, it's between 3 to 10 trades. That would be like some sort of an average, I suppose. It's a big average. Coach D, can you show us how to use that anchored VWAP tool? Yes, it's very easy on this platform, and this is the reason why we all like it for that matter. So you will find the anchored VWAP in the forecasting and measurement tools. Let me make sure you can see that. Yes. So right now I have that set on price range, which is also in my favorites because I like to measure things throughout the day. But if you click on this little arrow on the side, you won't be able to see that. Let me remove the face. Alright, now you can see it. So if you are looking for anchored VWAP, so go into forecasting and measurement tools, and then if you scroll down sort of to the middle of the section, it says volume based. And you have 2 of them, fixed range volume profile, which I also use. That's how I draw the value areas on this this particular platform. Then you have anchored VWAP. So you click the anchored VWAP, and you're going to anchor it to wherever you want. Like for example, you can anchor it to the start of the London session. I like to anchor it to LME Open and to Globex, which is done automatically with the regular VWAP. But for the anchored VWAP, let's just say we're going to anchor this to the London Open, and I want to make sure that it is really at the London Open part. Once you click into settings on the actual line, so you kind of, if you click away, click again on the line, you will get all of these lovely settings that suddenly appear. So go into settings, you can anchor it to anything. Like I said, I like to anchor it to the open, but you can also anchor it to the high. You can also anchor it to the low, right? So just make sure that you're anchoring it to whatever your actual intention is. But right now I don't really, I don't like session VWAPs generally unless we're in some kind of a range bound day. In that case, I will use the session VWAP as my target because it's usually through the middle of the range. It's pretty flat. That's another thing that I look for. How sloped is the VWAP curve? Is it sloping downwards, upwards, by how much? And it's a pretty good indicator. I mean, anchoring VWAPs is something that Coach Jay does a lot, and I love that approach. So one of the things that I've learned from Coach Jay is to anchor VWAPs on any kind of bigger candles that happen throughout the day. So let's say, I mean, this is a really terrible example because it's a low volume environment. Okay, well, we got a little bit of life coming in. So I'm on a 2-minute chart on the micro. I will use the full contract for this purpose because micros tend to lag and they don't show the full picture. But let's say that now we're looking for further momentum downwards away from VWAP. And let's say that you've missed the initial pop down because, you know, let's face it, a lot of the times when some of the initial movement happens, you don't need to be in on that. You need to be in on the follow through that comes after. So what I would do, I would take an anchored VWAP and I would anchor it to that bigger volume bar. So whatever the volume says in the surrounding area, that is the anchor that I will use. And then when the next candle comes in, it's going to show you whether you're below it or above it, whether we're reclaiming it or not. And it can be actually a pretty decent indicator of how the price action is moving. So I was never a huge volume trader. I always looked for more like momentum on the tape, like where tape gets faster, and then for the candles to not have any wicks if I'm looking for a directional move away from an area. I'm a core mean reversion trader, so let's say that we were here. Actually, this is a better example. Let's say we're looking at the start of this London session and we have this big volume spike. So what you would do, so this was a classic sort of exhaustion bar on the volume where this volume is bigger than the preceding 3 volume bars. So this one I wasn't interested in. I was asleep. Was I asleep? No, I was doing coffee and stuff. So, but you can see that here, if you're looking for a smaller swing, once it reclaims VWAP with a candle that has no wicks, this is a 2-minute chart. It's a very, very low time frame. I prefer 2-minute over 3 minutes. I know that Coach Jay uses 3 minutes, but I don't gel with it. Never gel with it for some reason. And then you see that the price action has reclaimed it. And it also took out the previous almost like 3 trending candles to the downside. That would be my entry point, right? And that, Manny, can you please be quiet? Or whoever is growling. It's not Manny, it's Crichton. Why are you being so vocal? Stop it. We're trying to work here, man. Okay? I have 5 dogs in here, and they're being pretty good, but now one of them has a cow's ear, and he thinks that the other guy wants to take it from them. We don't get fights, we just get like disagreements where they're like, so they make noises. Yeah, hello, you want to say hi? You want to say hi? You're being a bit noisy. Come on up. Come on up. You can make it. There he is. There he is. And he's wearing lovely pants because he's had a snip to protect the area so you don't lick because you're a big licker. Yeah, so this is Crichton. He's a cutie, but he's exhibiting some herding behavior, so we're trying to sort that out. All right, so my entry point would be this area when we go above this anchored VWAP based on the volume bar exhaustion. So if you then enter a trade, you can use the previous, you don't have to use the entire wick, because if that starts getting chewed up, then it's not the same trade anymore, and that's your invalidation point. But the wick tells you a story of a sweep and a reversal. And the reversal tells you that this is my entry point. And then you're looking for the price to pump to about, for me it's 2R multiples. And the reason why I use 55 ticks, 2R, and then slightly smaller amounts when I'm doing more of a scalp, let's say 30, is because of this, right? Look at the swing and look at where it turns around. So on a 30 tick stop, if you're doing a scalp, you have quite a high chance of it reaching the MFE of about 60 ticks. So if you take that into calculations of your targets, database, right, and how often that particular stop loss reaches your intended 2R target, how many does that happen? Like regardless of the entry point, I use the random entries for this just to like measure the MFE. And then I take it through like Monte Carlo simulations to see how many times that might happen. And then I do the same for my actual entries. So it's like assume these conditions, and then you basically run it through an algorithm and it spews out some data. Now, the back testing is never going to be as good as forward testing. So I'm always doing out of sample tests as well, which is why combines are amazing, because you don't have to put real money to do it. You just pay a little bit, get into a combine, and then you just go, well, I have this assumption, I have the back test, now let's see how that performs in real time and how you feel. Like I think that the feeling of the trader whilst you're in a trade, it really matters a lot. Right now we're below all of these VWAPs, but it's too early, and I know that this product loves to turn around and smack you in the face when some more volume comes in. So we're going to be patient here. And we're sitting right at the gamma flip level as well. That's terrible. If we get to Asia low, I might be looking for an exhaustion candle, kind of like the one that I showed you. So I would be looking for an exhaustion sweep downwards with a big volume bar, reversal, turn around, so you anchor the VWAP, turns around, look at cumulative delta, and then if you get cumulative delta sustaining, you don't want to see any, how would I explain it, any sharp declines in cumulative delta if you're going to be long. So let's assume a long position from Asia low, and then you see that exhaustion volume bar, they bounce back. And then cumulative delta rises, and they start to move it away. But then suddenly, for whatever reason, the delta has like this sharp spike down. That's an early exit for me, because I don't want to see that if I'm looking for a directional move. It means that whatever the prices did so far, the delta is not following. Delta needs to follow. You need those aggressive intraday traders to keep pushing it in the correct direction. And sharp declines in delta to the opposite side of my trade is almost always bad news. And then I will exit, reevaluate. If that starts to recover, and if it continues to then settle and then rise back up, I will re-enter. So all of my decisions are based heavily on order flow and tape, but then also with the help of some candlesticks and how they're closing into important time frames. Important time frames for me are first and foremost 30-minute time frame, right? So that's the TPO profile time frame. So even if I'm front running a trade, I will still look at how the 30 minutes is closing. If you were here for group coaching yesterday, we were on with Hogue and Hoop, and we got a question of why we like the 30-minute time frame and why we use it. And I said, well, personally, I noticed even before I knew about profile, when I was still a swing trader back in 2007, 8, 9, I still noticed that there's something going on the 30-minute close. Top of the hour, bottom of the hour. I didn't know the reason, and until yesterday I still didn't know the reason, but I just assumed that there was some like algorithms that institutions do that kick off at that time. So therefore it gives you a pretty good indication of what's happening. And then Hogue, with his infinite wisdom, he said, yeah, well, I used to work as a broker, and funny you say that, But there are institutions who will only execute on the half hour. And that's because when they have a client that, let's say they want you to fill like 2,000 ES contracts. They will want to get an average price for the day. So they're not looking to outperform the market intraday like we're doing. They're just looking to get the daily average price. That's all they're looking for. So they instruct the brokerage to, they instruct the broker that they're working with, so Hogue was one of them. They instruct them to take discretionary positions. So it's like, try to get me the average on the day. And that means they were given the discretion to enter the market whenever. And Hogue used to have a guy that he used to execute orders for. So he said, the guy would be telling me, okay, well, on every half hour, enter this many positions. That would cause those jolts. Now, as the time went on, those sorts of behaviors carried on into an algorithmic form of trading. And they're still there. You can see them. Like if you wait for the 30-minute bar to close, you will suddenly see the flurry of activity and then they do something that's like the ultimate decision. So I always watch the closes of the 30-minute bar, and they will lead my decisions on my OODA loops. So that stands for Observe, Orient, Decide, and Act. Anne-Marie calls them OODA loops, which I think is pretty fun. The OODA loops, kind of like Oompa Loompa loops. But I always used to call them OODA loops. So that stands, like I said, for Observe, Orient, Decide, and Act, taken from the fighter pilots training. So you observe the level, what's happening, orient yourself, how we're doing on the day, is the auction strong, weak, medium, and all that. Decide what you want to do. Do I want to be long? Do I want to be long? And then act, enter a trade. And it's a beautiful way to kind of keep your mind from spinning into the gambling behavior. If you train your brain to always look at that and always to ask questions, where are we? How is the price doing? Should I be in this trade? Are we reclaiming VWAP or not? Is the delta rising or falling? Are there any sharp declines or rises in delta? If there's a sharp rise in delta with my long trade, oh, I'm staying in that. I ain't going anywhere. Because it's usually preceded by additional momentum. And if that rise in delta happens on the half hour and on the TPO close, I'm definitely staying in. And I don't care what happens in the next 15 minutes. I will still try to stay in as long as possible. And that's what enables me to get an average of usually 100 minutes. This is a newer combine where I'm testing this execution, but you can still see that my average win duration, this is pretty reflective of what I do. So it's 74 minutes. So I don't nitpick, right? I'm not like, oh yeah, I'm going to be doing scalps and stuff. Even my scalps, they're 30 to 45 minutes long. They're not tiny. And actually, if I trade for longer, when you take all the swings and stuff, this actually rises to over 100 minutes. And it's just the thing that works for me. Right now, I'm overperforming myself, so 58% is actually pretty high for me. Yeah, anything above 43% and I'm fine. So yeah, let's carry on. How can I set up my dome chart with those volume settings? So these are not volume settings on the dome. They're actually level 2 data. It's not volume, it is resting orders in the market, which accounts for liquidity. The way you don't set them, this is a service provided by the CME via Topstep. So if you go into your add-ons on your new dashboard, there is a thing called level 2 data. If you're in the US, it costs $34. If you're in the UK or EU, you might need to pay some VAT on top of that, which is 20% or something. And then what Topstep does, they just pass on those fees to CME, and CME then spews out level 2 data, which shows up on your platform. But be careful, because the CME only operates on a cycle of 30 days in calendar days. Therefore, if you sign up, let's say that we get to the 20th of the month, and someone buys level 2 data for $34. On the 1st of the next month, you will get charged again. Another $34. So you will only get like barely 10 days in February, 9 days. Is it a leap year? Is it a leap year? It's every 4 years, isn't it? So it's not a leap year. So it's going to be 28 days. So you're only going to get 8 days of data before they charge you again. We are at the beginning of February now, so maybe you're okay with getting level 2 now. But just be super mindful of that as you are purchasing level 2 data. And this is nothing on Topstep. This is on all of the platforms. It all goes to the CME, whether it's TraderVate, TradingView, it will all get charged. Level 2 data will always get charged on the 1st of the month. Brian says, I finally did it. I'm eligible for a payout. That's amazing. I can take out 3,069 tomorrow. That is awesome news. Everybody, please say amazing work. Put a W in the chart for Brian. That's exactly what we want to see, right? So you've been working at it, and finally everything starts to make sense. Everything begins to happen. So the first payout is the first of many. Just watch your bankroll. Watch your bankroll. No, and make sure you size down after payout as well. Because remember that when you take a first payout, your maximum drawdown goes to 0. And from there on out, that's your working capital. So that's the only things I am going to warn when it comes to payouts versus the amount of balance remaining in there. Mario says, hey D, what is actually the benefit of trading futures instead of CFD and spread, since you can manage risk in terms of size and never have to risk not being filled? So here is the problem. CFDs and spread betting accounts, first of all, are illegal in the USA. So for the US residents, they are not allowed because of Dodd-Frank legislation. Why? Because CFDs at best were partially regulated and remain to be only partially regulated, even over in the UK. The spreads that they give you, like for example, if you want to trade copper, you will be hit with a random plus 10 pips spread that is not rooted in any liquidity or anything. It's just brokerage wanting money. You can see that right now, there is no spread. If you enter at 583, you're probably going to get 583 or maybe 583.05, so one tick spread barely. Another positive thing is that they are properly regulated products. Therefore, it doesn't mean whichever company you decide to go to, they all derive their spreads, which are based on dealer happenings, how much the dealers how tight of a spread the dealer can give you, and not some random broker who's like deciding in a CFD space to put a 10 tick spread because it's an odd product that nobody trades. So how do we do that? I'm just going to add. So you would enter a position, and then your price wouldn't be 583. It would be 583.50. So before you even start, you have to account for the fact that you're going to have an extra 10 tick spread. And sometimes it's crazy. Sometimes they go to 15 ticks, 20, 25. Like the odder the product, the larger the spread they will put on. That's always bothered me. Now, the second problem is that the futures, when you place your money in a futures account, you, in case of any sort of default on the broker side, you will be seamlessly moved to a different broker with no fuss, no nothing, and your money will still be there. If a CFD brokerage goes bust, and let's say you have ballpark 500,000 sitting in there, which is what, many of us who have been in the game, we have larger accounts. I'm not going to be trading with like 4.5 grand, am I? So the CFD space can only protect your money up to 50,000. If anything happens and you've racked up like $250,000, $500,000 in there of profits, in the case of the admin, so they go into administration, what happens is that you will only be protected for 50K, and all of the other money is just going to be poof, gone. Not because of bad trading, because they don't have to pay it. They might pay it out of the goodness of their own heart, but legally, 50K is all that you're protected for. So I don't know. To me, all of that is pretty bloody dodgy, and I would never put my money in a CFD. I haven't traded CFDs since I moved into future space, which is 2013, and I did some forex trading, but even that was done via futures ever since 2016, and then I just moved completely into futures, and I haven't really looked at any CFD products since. I think they are designed to work against the trader. I think the companies are very much looking forward to the commission fees. There's that joke. There's a joke. It's like, oh yeah, if you see a broker walking around with his hands in his pockets outside, it means it's really cold. Hands in his own pockets rather than the client's, right? So yeah, it's just a... I'll see myself out. Okay. Bad jokes. Dad jokes, almost. Alexander is asking, how are the doggos? They're fine. So Manny and Crikey had because of certain behavioral problems. The rest of them are fine. We do have 3 of them that are food intolerant. So we have chicken and beef intolerance. So, you know, every so often they will yak up because somebody fed them something that's not supposed to. But overall, they're pretty good. Their dad, the eldest Cavalier, he's doing well. He's still coughing, but we got him so stable on this new drug. He is in heart failure. He is 13 years old. He's a King Charles Cavalier, so he's beaten the odds already. King Charles Cavaliers usually live up to about 9-10 years on average. He's 13, so already he's kind of going into that normal lifespan, so we're very happy about that. I was looking at putting him down in November because his heart failed and he was just struggling. And then we heard about this new drug called Entresto, which replaces some of the ACE inhibitors and stuff that were a part of the old therapies. And I read up about it. I spent like, a week going through like the research documents. Not that there's too many studies. There's like 2 studies on dogs, but there's a lot of studies on humans because it's the same drug used in humans for heart failure. And I just poured my soul into like all of the studies that I could get my hands on. And I made a decision that would be a good option to try. Within 3 days, he bounced back. He started running around, and he's not supposed to run, but how are you going to stop a dog, He comes back from the back garden, and they love the back garden here. We have about 500 square meters of space around the back, and that backs onto a farm, which we don't have access to. They have like cows and sheep and stuff, but it's all part of the same sort of farming estate, and then we own a piece of it. And I'm not a farmer. I don't, this garden is arguably a little bit too big anyway. But the dogs love it, right? So they go out there, they ramble around, they're not back for like, 45 minutes, 50 minutes. I'm like, what the hell is he doing out there? And they're just sniffing around and doing stuff. And he started doing that. So he still sleeps a lot, but every time there's something happening, he's awake and he's like, ooh, what's happening? And then it took about 3 weeks for him to start eating normally. So I had to hand feed him. That was a little bit frustrating. We got the blood work. Everything's looking great, especially considering his age. Like literally most things are within normal. The only thing that was slightly elevated was some of the liver enzymes, but it was still like literally just tagging the higher normal. Nothing to be concerned about. So I put him on like a liver cleanse thing. There's this thing called Hepatocil. And I actually had a dog before that had problems with high liver enzymes, so I know how to deal with that. But his ones are nothing like it. They're just like a tiny bit elevated. I don't know how long we've got with him, but I will take every day as it comes. For now, apart from the coughing, which is caused by the enlarged heart pushing on the trachea, he's doing really well. He is very active for what he is. We did take him out of doggy school because I think 4 hours a day for him at this point would be a little bit fatal. So we may get him back in. The good thing about this new drug Entresto is that it can remodel the heart. Doesn't take care of the damage. The damage is still there. So it's not like a miracle cure that reverses everything, but it can get the heart down to like some less enlarged size. But I'm very aware that this drug is not going to cure him. It is literally just extending his time with us. So that's a little bit sad, you know, obviously, but I'm focusing on the positives. We're taking it day by day. He's eating well. He looks happy. He is enjoying his time on the walks that we take him. He goes out 5 times a week with us for an hour. He used to go doggy school. He can't do that anymore. But it's just beautiful to see that he's not struggling. So for me, quality of life at his age, at this point with his disease, that takes precedence. So for now, he's doing amazingly well. For how long, I don't know. At some point, Entresto will stop working because there will be further damage. And then I don't want to torture him, so I'm going to have to make the horrible decision. And then I will probably be on here just blubbering and crying for a while. Because, you know, I do... The only thing with Lenny is that's his name, Lenny. Leonard, the King Charles Cavalier. His full name is actually, because he comes from like pedigree, his full name is Leonard St. Ledger Autumn Boy. I always find those like kennel names is hilarious. They're the British Cavalier like society, the official one, and his lineage is like champions upon champions. So, you know, he comes from a good breed, but they all suffer from this bloody MVD. It's like so annoying. And it's such a horrible disease. You're basically drowning in your own fluids. Now, the good thing about him is that he didn't have fluids in the tummy or anything. It was just a little bit around his heart. And as soon as we put him on Entresto, that went away within the space of like 2 weeks. So yeah, the doggos are doing well. Most of them are absolutely fine. They're happy. They love their pals at doggy school. They love the big field that we have 1 minute down from where we live. It's all secure, so you know I don't have to worry about random dogs. They have their mates. There's always like similar dogs in there. The owners who own the doggy school are very mindful, and they do a thorough assessment of the behavior in any dog that they take. So we had to do like a trial one at a time, apart from Leonard, because he's old and deaf and just generally not a problem. He just went in, because, you know, aggressive King Charles Cavaliers, like, it's not really a thing, is it? He has a streak, though. Like, whenever Crichton annoys him, you saw Crichton just a minute ago, he will double snap at him to put him in his place. And to me, that's like the only thing that I can't do as a human. Dog on dog corrections, when one of them is like misbehaving, there's no substitute for that. So I do let him. I'm like, you know what, you're right, he's being a bit annoying. He's being a bit of a and it's amazing how much Crichton just responds to Leonard's corrections. He doesn't respond to my corrections. I poke him in the neck and he's just like, yeah, whatever, mate. And then he just continues. I'm like, dude, come on. Crichton has a bit of an independent streak. He's everybody else, great recall, right? You call them, whatever they're doing, they're like, yes, we're running. They were all trained the same way. And Crichton, you call him, and he's just like, who are you? I don't know my name. What, Crichton? Who is that? And then he just goes off and does something else. It's, yeah. So it's a, you know, out of the 6 puppies, and, you know, their mom, Lisbon, and Leonard, we only have one that is a little problematic, so that's fine. Alright, Dee, can you elaborate more how to use order flow in your trading decisions? I think I did mention that a little bit. Now, I would probably need to dedicate like 2 hours just talking about like bookmap events and stuff. But basically you have momentum, which is like subsequent bigger volume transactions that just keep going. And they keep pushing the price in a direction. You have sweeps that can be with direction or against the direction. Sometimes they can be precursors of the reversals, so I like those because I'm a mean reversion trader, but they have to be at the right spot. You can't just go like, oh, sweep in the opposite direction, I'm going long. It has to make sense. So it has to be either at Asia low or ADR low, or on the opposite side if you're shorting, Asia high, ADR high, some sort of gamma level that with a lot of open interest and implied volatility. And this is why I have these points. So for example, this is a bigger call wall, but really I'm looking at this one. Why? Because it has the most appropriate combination of high open interest and good implied volatility there. So that's why I'm calling that a magnet. And I'm expecting some dealer hedging to happen there. They might overshoot it, but ultimately this should be the logical stopping point in light of the range and stuff. So once we arrive there, I will be looking for the following. First of all, maybe a sweep through and then a reversal. So reclaim of the range. And then I'm looking for consecutive aggressive sellers to step in. So how do you see aggressive sellers? Well, on Bookmap, they are in bubbles. And I like to use the total delta on the bubble itself. So it's not like just a regular default setting. I change it to... I actually did the Bookmap settings video on YouTube. I don't talk about the events there. I just talk about like what's on my Bookmap. And then you can also get absorption. So you see a lot of transactions. There's a lot of volume. So they're pushing, but nothing is happening in the price. And the bubble is almost like 50-50. Now, those are very interesting because it means that somebody is absorbing whatever the aggressive short-term sellers or buyers are trying to do. So if you have short-term buyers that want to keep pushing, but then you have a big seller that is like, you know what, yeah, I'm just going to put all of my cash flow into this level because I believe in it and I want to hedge here, they will put a lot of money behind the opposite of whatever the retail is doing, right? And they will win most times. Sometimes they don't. Sometimes they just stop and then it goes higher. But most times you will see it in delta, where the delta during the absorption is either slightly falling or it's just not rising further. That's another little clue. It takes a long time to get your eyes used to like these patterns. So it's not like, oh, you get Bookmap and you get level 2 and suddenly you become this amazing trader. It's not going to be like that. So expect a learning curve of at least a year, maybe 2 years for some people if you're not very consistent with it. But I know that it took me a while to get the grips with the time and sales window, which I always found horrendous. So I really welcome the addition of Bookmap, which gives you all of the beautiful sort of cartoonish representation of what is going on. You've got heat maps, you've got everything just smushed in one very nicely organized piece of data that relates to the order flow. But also remember that the auction process is order flow as well. So if you're looking at the TPO profile, how the auction is doing, are there single prints? We talked about that yesterday, right? That's also very useful. Okay, so for now they're fighting around this gamma flip level. So one of the reasons why I'm not looking for setups here is because it's middle of the range, right? So we have Asia here. We have this range established. Where is it in the larger swing? Absolutely nowhere. It's here. So we're not down here, we're not up here, we're in the middle of the range. Middle of the ranges are at best a coin flip. And if you have VWAP there and no volume, you're just going to be stuck watching paint dry. So this is why I'm rarely executing new positions during this time of day, because this is just not the setups that I like to go for, which is why this is more of a class, right? So we get to chat and get to answer questions and talk about, you know, passing, combines, bankroll management, order flow today as well. But yeah, so I have several events that I look for, but ultimately you're looking for volume that is supported by delta. You're looking for momentum that keeps going in the same direction. You don't want to see any sudden declines or rises in delta, especially when you're entering a position and then it happens against your trade. So if you want to be short around here and then suddenly the delta starts falling off, it's like, oh great. And then all of a sudden they go long and then delta rises. That's actually bullish divergence. So at the point when areas are going to fail, you will typically find the divergence in the continuation direction. So how does the bullish divergence look? It looks like price going down, so making like lower highs, but delta keeps edging higher. Delta is not stopping. That's usually a precursor for continuation. So that will be one of the things that I look for when the setup will fail. And I don't think that that's talked about enough. The bullish divergence when you're expecting a short. That's a bad sign. So then you see the price falling, which can seduce you into thinking that this is the right decision. But then you look at delta and it just keeps edging higher. Keeps going higher and a little bit higher. And you're like, okay, they're not shaving delta off. Let me get out. And then it goes smash. And you're like, oh, it went higher. Great. Good thing that I'm out of that. Jesus. So you want to see everything in confluence, effectively. So congruent with direction. If you're looking for shorts around 6 evens, like I will be at some point, if we ever get up there today, I don't want to see bullish divergence between delta and price. I don't want to see sweeps to the opposite side that hold above 6 evens with no selling wicks. I want to see absorption, so I want to see those bubbles that are even. I want to see delta falling off a little bit, and then I also want to see big aggressive buyers stepping in via big red bubbles and then continuing to shave cumulative delta off in the negative direction, even if delta is positive, right? So you might have like plus 200 delta, but then it falls down to 100. Then eventually it kind of goes 79, then 50, and then eventually it's going to go negative, but that takes a while. So it's basically the curve of the delta that really helps me. I don't know whether I'm explaining that. Order flow events are very, very difficult to explain when you're not actually watching them. But yeah. So for example, right now, another thing that's keeping me away is this spiky delta. Like, what the hell are they doing here, You want to see, this is probably some lack of interest or something. So this area is not interesting for the big boys to get involved. And therefore, they're just chopping in a range. So delta that looks like this is not something that I want to get involved with. And delta that looks... Let's go back to Asia. So here we go. Now I've really zoomed in. And look at how smooth that delta is. Look at smooth. Very smooth. Smooth operator. Put a shawty on you. Okay, so trading nickels. I actually calculated how many trades I could be tilting. It sucks when I get cut off when I'm making money, but then I really make those last trades count. And generally, I do a better job holding the trade, and I make more. Yeah, it's very good. If you're getting tilty, then you definitely need to have some breaks happening. My maximum trades per day is 30, but with increased discipline and not taking profit on the way to targets, has helped me achieve maximum daily earnings or loss in fewer trades, which week by week I'm getting better at. Yeah, better profit flow, even though it's jarring to not go for the winning every day, which, let's be real, always trying for that is expensive. Yeah, so don't... Yeah, so again, you need to find... I don't go without profits for days. That's not what I'm talking about when you're trying to catch bigger portions of the move. I'm not talking about capturing 500 ticks every day. I'm talking about still being up on the day, but using the profit targets that are realistic within the swings that this particular product does within a particular time period. So for me, that will be about 2 to 4 hours. So let's have a look. So 2 hours is about four bars on the 30-minute time frame. So let's do some measuring here. So how much, on average, does this product move across any random 4 bars, high and low? So let's take 1, 2, 3, 4. So here we go. This is a bigger swing. So bigger swing, 158. You can actually use AI to help you with this, but this is how I used to do it before the invention of AI, because D is old school. So 158 ticks. Therefore, my target of 110 ticks still tracks. Let's have a look at more range bound. So 1, 2, 3, 4. Here we go. So from the bottom to the high, it's again 150 ticks. So again, even if I was looking for a trade in a range, I would still have 150 ticks to play with. Let's go back to a quieter time period. Here's sort of pre-COMEX. Another 4 bars, high and low, 80 ticks. So that's definitely lower. Also volume is lower. Let's have a look at any old day. 1, 2, 3, 4. Again, random 4 bars. I'm not looking at swings or anything. I'm just literally going 1, 2, 3, 4. So there's this one. Again, 152. Notice how that number doesn't really change all that much. So we had one that was like 80 ticks when we got stuck in a quieter period. And then during Asia, here's another quieter period. So 1, 2, 3, 4. 104. So again, 110 ticks, you know, if you're looking for 110 ticks and you're pretty decent at exiting just ahead of that statistically favorable target, you will still grab like 80 to 100. So you can cut the trade early if you run into a time period when the volume is low. But notice that whenever we have regular movement, wherever I take, you know, the highs and lows from, we're working with MFE of 80 to 150 ticks. So whatever kind of trader I am, within a 2-hour period, I can expect a movement of about, let's say, at least 110 ticks. That's what my target of 2 hours is based on. It's not based on a random number that I pulled out of thin air. I've based it on the behavior of the product. So if you're not doing that for your targets, how often would this target get reached in a particular time period? So let's say you're a 30-minute bar trader. Let's see what that does. Go to 5 minutes. So you're holding your trades for 30 minutes, which again, for some people is too long, right? You guys, like, I've seen your reports. Let's take 4 bars, 32 ticks in a quiet period. Let's take a more volatile period. So any 4 bars, high to low, 71. Okay. Then let's take this one. 1, 2, 3, 4. This one was a bit bigger, so we go. That's 43. Let's take this one, a bit spiky. Again, 77, 80, right? So you're working with ballpark 40 to 80 ticks movement in a 30-minute period. That would be a target for somebody looking at lower time frames and maybe being in a slightly smaller time frame. But I think many people try to scalp before they are actually ready and before they actually know what they're doing. You know, for scalping, we've had one person in here who is a scalper, institutional scalper, and his way of assessing a scalper is having a year's worth of data and more than 10,000 trades for a sample size. Only then you know where your edge is. I've said this before. So if you don't have that, what are you doing? So yeah, maybe use the MFE analysis of how much did this product move and what is the target that most frequently would get reached within these parameters. I can't give you those because obviously I have a different style of trading and my parameters are much different than most people's. And it's but it's a very useful measure. So yeah. Trading Nichols, you and Coach Ray got me looking at 2 minutes and using channels. Yeah, he uses channels. I don't, but I worked with him on a 2-minute bar, 2-minute time frame because that's my favorite time frame. That's where that's the core part of Market Stalker's method. When you're trying to optimize your entries and you've learned everything else, and you're getting to the point where you're like, let me see if I can, now use a 2-minute chart in order to get in earlier. And he uses channels. These days I like to use the anchored VWAPs because that really speaks to me because it's rooted in volume and it's rooted in order flow. And it just makes sense for my style of trading. But I still look at the patterns, right? I will still look at how, regardless of what the order flow is doing, how did we do stuff. So for example, with this thing, you see that the price reversal was very decisive. So you anchor a VWAP, and you look for a reclaim of that VWAP without selling wicks, that's your entry. If this was also wiki, my next entry would be this one, because it's the only strong candle that takes out the previous 3 trending bars and really commits. And sure, it might chop around, obviously you have to account for that, but again, it's very good way of looking at things. I differentiate between strong and weak, bearish and bullish engulfings. So for example, this one would be fairly strong, but because it's in a consolidation, I would be a little bit careful, because the consolidation bottom was the bottom was the consolidation bottom. What is that accent? I don't even know. So that would be more ideal if this closed below the consolidation. So really my entry would be this one, not this one. But if the bearish engulfing went all the way below that and closed strongly, because we're talking 2-minute time frame, you can't use the same arguments of strong bullish engulfing versus weak bullish engulfing versus 2-minute and 30-minute time frame. It has to be more pronounced because it's a lower time frame with a lot of noise. So whilst I may say that on a 30-minute time frame, this would be a relatively strong bullish engulfing that I might want to get involved, because this is a 2-minute chart. This one is not even taking out the previous trending candle, let alone 3 or 4 or 5. Therefore, that would be not something that I look for. Too messy. Then let's have a look at, this is all out of hours. Out of hours. This one, same thing, barely takes out 2 bars. I mean, you can kind of use it if you have a level there. You can sort of go, well, I still think this is going to work, right? You can use some discretion over it. But really, the ones that are pretty strong as reversal patterns, I am very... Here's one. So this is kind of a 3-bar reversal. I wouldn't call it that really, because it's more of a 3 inside down pattern. I suppose it's a 3-bar reversal. But that's a strong one because it took out all of these guys and even tried to take out the previous support here. And then they basically give you a nice little swing. We had a magnet that's been here, like that 6 evens level. But even that would bring you... like that's like a 100-tick movement, 93-tick movement for the point when it gives you the sign, right? And everything has to be done at the right time of day as well, so it's not like, oh yeah, I stare at the 2-minute time frame and expect results. No, I combine it with what I see on profile, what makes sense. Can I name the playbook? If I can't name the playbook, I shouldn't be in the trade. The theories of extensions versus reversals people look for on 4-hour candles so much. I check the 3-hour in case it tells the opposite story. If so, I doubt that the 4-hour is telling me. The problem with 4-hour is that it's good as you're arriving in a 4-hour supply or demand zone, but I don't really... I think that people who are looking for, like, let's say, halfway point, if we cross halfway point of the previous 4-hour, then we're going long. Like, shouldn't you find a trade as an intraday trade before you go like a million ticks away from the middle to the middle of the 4-hour bar? I don't know, that just doesn't make sense to me. But if we are arriving in an area that was a previous swing extreme, that would make sense. So for example, if we arrive at this area where the ADR high is, incidentally, that's a consolidation, so that's a rally-based drop, RBOB, if you're a devotee of the supply and demand, real like supply and demand that everybody was using back in the day. I made a ton of cash just swing trading supply and demand on 4 hours in daily chart, but it is not an intraday strategy. It's a good awareness strategy of where you are chart location wise on a larger time frame. But I would never use the concept of, hey, if we cross 50% over this, like, why not then wait for a wick below Asia low and grab it here and then take all of that? That's the part where I'm pretty picky with my entries and how they look on these large time frames. But if we get up here and then we start to turn around, again, that's something to look for. But would I be looking for it to cross over the previous? To me, that's overkill, because I can already see that we've reversed from an area of a supply. Does that make sense? Or am I just babbling? But, you know, I look at these swing points. You know, I always start my analysis on larger time frames. So where are we now? Well, on a 4-hour time frame, we have some demand that is actually pretty poor quality. So I don't like the look of this. Therefore, I would be looking for, you know, maybe a deeper test of that. Or I will look to the left to see what we have further down. And here we go. We have a good quality demand that has a very nice, a sharp move away. We have not returned to it recently. Maybe we had a pop into it. Okay, so we had a pop into it 2nd of February in and around 3 a.m. So, you know, 5 a.m. or something, because it's a 4-hour time frame, before it turned around. So what happened? Well, it dipped. I didn't even look to see whether there was one, but that was a good quality demand. What makes it a good quality? Well, several conditions. First of all, the strength of the move away. Does it touch the area again? Because retests on the creation of the initial demand, that's a bad sign, and the scoring has to like take a hit. But this one moved away, stayed away, went into a proper swing, created more supply and demands on the way that are also not particularly good quality. But this one, is it an accident? This is exactly where we bounced from. So if you can read that, and you can sift through the strong and weak demand zones and then go, these are the ones. You know how I do with gamma levels? I do the same thing with supply and demand. So this is a good quality demand. We should return there. And all of this drop, well, they just so happen to do it straight into the strong, high quality demand out of all of them. All of them. It's the only one that I can see. This one, no. Why? Because we dip right to it without moving away from it. This one, again, this wick dips down into the same area. This one, same problem. And it also doesn't give you a big swing, low quality demand. This one, same thing, never actually moves away. More than like barely 1 hour of the entirety of the initial reversal zone. This one is okay, but I don't like this wick. So it started off as trying, had unclean arrival, they smashed it, then they reversed it, then they tried it again. But the whole swing that went, you know, through it is just not good. The initial run up was also not as big as some of the other demands that we have. There was another sort of offspring demand in here, so this one was okay because this move. So you're looking for basically strong pushes outside of an area that then creates a new swing. That's like the core idea of a good quality demand. So out of the supplies, let's see what we have on the supply area. So let's just get rid of this to make it a bit clearer. This one, low quality supply. Why? Because we go below it, then dip once into it, then dip another time. So we move away, jumping, but eventually it kind of gets going. But it's a lower quality area. This one immediately dips into the point of market shift. So again, low quality. You know, most people look at supply and demand these days, oh, there's a high, there's a low. There's more to it, guys. Like, there's a lot more to it. And I was a supply and demand specialist for many, many years before I started adding onto things in order to get better intraday, right? This one also crappy quality. Why? Because we dip into it. So we move away from it, pop into it, and then carry on. No. So we don't really have very good quality supplies anywhere. And the supply area also has to be untraded. So that means that the highs of the supply still have to be enforced. Therefore, this one was already smashed through. This is not a demand. This one also smashed through. This one. So you have new reference points. Like I said, this one is just about okay. I think we did spend a little bit too much time just going sideways, and then it kind of smashed lower. So this is a higher quality area, but it is not exactly at the swing extreme of the bigger swing. So that is a little bit of a pain point, but still usable. However, look at the movement, pretty decent movement to the downside. So if we get up here, I would expect at least one time to have some sort of a reaction downwards before we carry on through it. So that's your supply and demand course in 15 minutes. Backtesting helps me learn instruments so much better. It helps me forward testing accuracy spikes. Yeah, me too. Backtesting gives me confidence that I'm looking at a strategy that I can see developing in real time. And then forward testing is literally just a way to say to myself, well, am I comfortable with this? And is this sustainable for me? How do I feel? Do I feel jittery? Do I feel uncomfortable that I'm increasing the average? How much am I increasing the average? Like this whole thing that I'm practicing now, right? The executions. I was always bothered by my average being increased whenever I add on to a position. So that wasn't an option for me for a long time. But starting with the multiples of something and then adding 1, 2, 3, and 4 at reasonably interesting points based on MFE of the actual product. That makes me comfortable. Why? Because my average only increases from 55 ticks to 61 ticks. So I do take the hit on the 2R by about 17%, but the expected value over time is bigger because your losses are smaller and your winners are bigger because you've added. So whenever a 2R core trade works out, but you've scaled in 4 times, once with a big position and then 4 times with smaller positions, what does that mean? It means that every 2R target actually carries more value. But every loss that you take immediately is not nearly as horrendous because you're only taking a 4 micros rather than 8 and 9 micros loss. Does that make sense? So that is what the expected value is. So it looks at like, it weighs the pros and cons and tries to amplify the upside, minimizing the downside. So that's one thing that I never really thought about. I was like, yeah, whatever. It works. Let's go. But yeah, I really want to minimize some of this variance that I've been seeing in light of such big movement, right? So yeah. I'm having trouble with cumulative delta on ES during slow periods of NYRTH session. The price drifts higher while cumulative delta just moves down. Yeah, so for cumulative delta, in order to give you proper signals, that would, you really need to trade at a higher volume times. So if you run into a slow period, please don't try and look at cumulative delta. This is why I say time of day is a level, right? We can't just be trading here for 12 hours a day at all times of the day because they're not good. This is not good, right? I'm not going to be looking. I told you cumulative delta, the way it looks right now, it's terrible. Look at how choppy it is. Like, what is this? Up and down, up and down, up and down. Like, it looks like somebody's, sewing went bad, like a stitch is going bad, and somebody's like having a stroke whilst it's happening. It's like, that's not a good thing. So you need the delta and volume to be plentiful, and that's when you can rely on those finer order flow details. If there's no volume, don't trade it. Like, what are you looking for? I don't know. Nobody can read that. In that case, just read what the candles are telling you. You don't even need volume because there's nothing to read. So yeah, I'm not surprised you're having issues. I have issues reading volume in low volatility and low volume times. Yeah. The Dark One says, lots of great info on group coaching yesterday. Even appreciate Hoag's answering my ridiculous question about the top step levels lately. What is a call wall? The call wall is a gamma exposure level from the options chain, and it is a level where the market makers, the big bad market makers, may hedge. So it's the bigger the level in the options chain, the more chances of a dealer hedging into it. If we are in an environment where mean reversions are plentiful from those levels. So anytime you see bigger call wall, if we are in something called the positive gamma environment, that means that the dealers will try and hedge their positions in order to remain market neutral. That's all they want. They don't care about outperforming the market. They just care about them being market neutral while they give us all the transactions to create liquidity so that we can have tight spreads or no spreads. But how do they do it? Well, they have to hedge at areas of high open interest from the options chain. So this is why these price points are very important, because they are taken from the options. I take them every morning. I have an algorithm that does that for me that I wrote. I also have things like an IV tracker day to day, and I also weigh the open interest against the IV implied volatility per strike. And I'm sure that if you don't do options, I just sounded like I'm talking Greek. And I might just might as well just be talking Simlish, because that's how options used to sound to me before I got with the language. Just know that market makers may engage. There's a high probability of market makers engaging at these levels. Whether they use it to go against the level or with the level will depend on whether they are trading long gamma or short gamma as their core options position. I realize that with the options you can't really simplify it. Like, I keep trying not to use the option, but how do you explain long gamma? Like, they are long calls against the retail who is short, right? So there would be long gamma. And that's a positive gamma environment, which leads to the mean reversions. How do you explain that without using the verbiage of options? I don't know. D, can we look at the Asia session today? I mean, yeah, you can. It just went down, and then it settled around 3 a.m., which is what it normally does. And then Tokyo, pre-close, they went into a bit of a big movement, take profit move. And then they settled. So your Asia high and low, Joe, are these yellow lines here. So it just went down, nothing. There is a chance that COMEX takes it back up, and that would kind of make sense from the range in the daily, right? So we are in a range in the daily. We have some sort of accumulation. It's very messy. That's why we want to zoom in. So we've had a low quality demand. We have an unclean arrival into the demand, so this could cause a bit of a pain. But if we can confidently go above 588, we have a very decent chance of reaching 560. Anything above that, I don't know. We'll see. But yeah, it's it was a fairly smooth Asian session. So they just started it, kept going, established a low around. So the low or the high for the Asia session in regards to the trending moves is usually established between my 2 a.m. to 4 a.m. I'm in GMT, so take a time zone converter and see what that is in your time zone. I know, Joe, you're in EST. But yeah, that's usually what happens between 2 and 4 p.m. 2 and 4 a.m. You can expect a high or a low to be established for the Asia session. Kind of like post NY cut, right? So we expect some sort of a high or a low to be established between sort of 1:30 and 4:30 p.m. GMT. So basically from the start of COMEX into the London close, you need to have, for a normal day to occur, they will usually stop at one of those times during that time period. And then, you have sort of an anchor for the rest of the day. All right, so it is 11 o'clock. I'm going to be... Oh, Cedric says, when you're profitable for years with an asset, what's the reason to change the strategy? Only small adjustments to the new market condition. So I always had a problem. So let's finish the stream with answering Cedric's question. I've always had an issue that I'm not able to, for some reason, to generate more return on a smaller account. And I work with a lot of traders now that only trade combines and small accounts. So I wanted to see if I can find a more sustainable way to increase upside and minimize downside, both for my purpose, but also for your purpose as well. And it never really occurred to me, Cedric. Frankly, the last 5 years is only a tiny chunk of my entire career. And yet we've had so many changes. Now, I've gone through a bit of a health issue, and I'm still going through it. So my brain wasn't working very well. But as I've started to kind of slightly recover from that, my brain is coming back. And now I'm like, why am I not doing something that should be sustainable? And how do I solve this? So now I have made tweaks. Everything else stays the same. My playbooks are the same. The levels are the same. Everything else. We are talking execution only, to use the metrics of the the risk parameters that the prop firm gives you in order to maximize upside while minimizing downside, and ultimately minimizing the biggest problem in the industry, which is blowout potential when you're trading with size. So I want to make that more stable going forward. And this is why I'm practicing, because I want to see how sustainable is this. It looks pretty sustainable. I will tell you that to me, making $1.5 grand in a day is usually a lot of pain. Here I was still practicing, so I made some mistakes on this first day, and this is why I need to practice first. So I was like, oh no, I scaled in. Okay, so I shouldn't be doing that. I should be doing that. So I was practicing for the first sort of 5 trades, and then towards the end of the day, I was like, oh yeah, I got it. And then I was also tracking order flow that I forgot to enter. And then I was like, oh yeah, hold on, I'm supposed to be practicing this scaling in thing. And I didn't scale in, and then it went away from me, so I was in only on 4. And I'm like, I need to write this down. So I started writing things down. I spent a whole day just writing 25 times, scaling in points, there. And then it was fresh in my head. Then I slept on it, came back the next day. Again, you're seeing so many more trades now, because for every 1 trade, I actually have at least 4 scale-ins. So that amplifies what I'm doing here a lot. But it's not 28 core setups. It's still 5 to 10 trades per day scaled in. It's actually less than 10 on this one. So I think I only did 6 trades yesterday. So let's see, 1, 2, 3, 4, 5. So you're going to have 5 entries. Yeah, so this is actually 5 trades, but added on to, right? And I've never been able to... Like if I made 1.5K, that would just be on 1 or 2 minis holding a trade. This one is starting on 4 or 5 minis, scaling up to 8 or 9, and then multiple sort of attempts per day. So 5 trades. Not on the same product. I traded 3 products. So I traded natural gas, traded copper, and I traded RBOB. So I did 2 trades on RBOB. I think I did about 3 trades on copper, and I think I did like 1 nat gas trade. So that was it. But yeah, so the tweak is for the benefit of what we're doing now, the prop accounts. Not assuming that everybody's wildly capitalized and they can just plop in 10 lots and then scale in with 1. I've done that as well. I love that. But how are you going to do that here? How does that increase your upside? It doesn't really. Just increases a little bit more. So yeah, that's the reason for it. You're always learning, developing as a trader. If you stop, I would argue that you shouldn't be trading anymore. We have to keep adapting. That is the name of the game. That's all I have for you today. I will be doing my own live stream on the Market Stalkers channel today at 6 p.m. GMT, which is 1 p.m. EST and 12 p.m. Central. So if you want to pop over and see my charts and stuff and all that, and we can be a little bit more relaxed, come and see me trade the end of the day. Come and see me trade COMEX settlement and see how I am maybe executing things at the time of day when I love trading, and that is towards the end of the day. That's all I have for you today. This was the Eurotrade, and I'm Market Stalker D. I will see you next week when we may or may not have some changes to the show. Stay tuned. This was TopstepTV. This was the Eurotrade. I will see you again very soon. Take care.